Have you ever just stared at the securities sector and wondered what on earth is going on? The price swings can be absolutely wild. Well, you're not alone. Today we're going to break down a really simple but super powerful strategy to help you figure out how to spot the winners in this crazy cyclical industry.
So let's start with a puzzle. Back in 2023, the market was coming back in a big way. But if you looked at security stocks, it was a totally different story depending on where you looked. You had some smaller stocks that just went to the moon, while the big, famous names kind of just sat there. So, what was going on? What was their secret sauce?
And check this out. This chart just says it all. Look at that massive gap. FTS, a much smaller firm, shot up an incredible 300%. Meanwhile, a huge industry player like VND, just 70%. Same industry, same market recovery. The key to understanding why this happened? Well, it's not where most people think to look.
To really crack this code, we have to throw out the usual investment playbook. See, for cyclical businesses like securities firms, looking at things like revenue or profit, it can be really misleading. Their income swings up and down with the market's mood, which tells you a lot about what already happened, but not much about what's going to happen. The real story, the secret, is hiding in plain sight, on their balance sheet.
So this is the big mental shift you have to make. For a little while, just forget about the income statement. To really get what makes these companies tick, you've got to get your hands dirty and dig into their assets and their liabilities. That's the real battlefield where the winners and losers are decided. And once you start digging into that balance sheet, a really fascinating pattern starts to show up. It turns out that most securities firms follow one of two very different business models. And knowing which path a company has chosen, well, it's like having a crystal ball for how they'll perform when the market starts to move.
Okay, so on one side, you've got the investor. Think of these as the high rollers. They use their own money to make big bets on the market through proprietary trading. Their whole game depends on how well those investments do. Then, on the other side, you have the banker. These guys are more conservative. They focus on services, like being a broker for clients, or lending out money for margin trading. Their biggest asset isn't a risky portfolio, it's their pile of cash and the loans they've made.
So let's take a look at a company like VND, a perfect example of the investor. At one point, they had a staggering 50%, half, of their entire balance sheet tied up in their own trading portfolio. That is a massive bet on the market. And when times are good, that looks genius. But what happens when the tide goes out?
Now let's compare that to FTS, who follows the banker model. It's a totally different philosophy. A huge 70% of their assets are in safe, liquid stuff like cash and CDs. Proprietary trading? Yeah, it's there, but it's a much smaller piece of the puzzle. They're built for stability, not for hitting home runs.
So we've got these two very different game plans. Now, let's put them on top of the market's natural rhythm. This is where it all starts to click, and you can see how a really powerful investment strategy starts to take shape, one that actually adapts to the market's mood.
Every market goes through this cycle, from a heated peak to a downturn, hitting a bottom, and then starting to recovery. Now, the big mistake most people make is they stick to one strategy the whole time. But in the securities world, the kind of stock you want to own at the market bottom is the exact opposite of the one you want to be riding during the big recovery.
And this right here is the golden rule for when things get ugly. When fear is everywhere and there's, blood in the streets, the company with the most cash is going to win. Period. They have the firepower, the war chest, to go out and buy amazing assets for pennies on the dollar, setting themselves up for absolutely massive gains when the market finally turns around.
Okay, so let's put this whole theory to the test. Let's rewind the clock to the market bottom in late 2022. We're going to see exactly how this framework could have told you which stocks were about to have an amazing year.
So here's your simple three-step checklist for bottom fishing. First, you got to look at what the firm actually owns. Are they stuck holding risky, illiquid stuff? Second, check the valuation. Is its price-to-book ratio near a historic low? Is it cheap? And finally, the most important step, follow the cash. You want to find the companies that are absolutely loaded with liquidity.
And boom! This slide just lays it all out. At the end of 2022, VND was sitting on over $8 trillion in corporate bonds. In that environment, that was a really risky, illiquid position to be in. Now look at FTS. They were sitting on over $700 billion in cash and CDs. And the result? VND puttered along, while FTS just exploded with that 300% gain we saw.
It's really that simple. VND was trapped. Their capital was locked up in those bonds. But FTS, they were holding the ultimate weapon at a market bottom, cash.
They had the freedom, the flexibility to go on offense while everyone else was stuck playing defense.
Okay, so cash is the rocket fuel when you're at the bottom of the market. But what about when the market's already taken off? What happens when we're clearly in an uptrend? Well, the strategy has to change.
So, if cash is what gets you through the storm, what's going to power the engine when the sun is shining? In a rising market, a totally different set of things start to matter, and that determines who's going to lead the pack next.
When the market is in an upcycle, it's all about growth, growth, growth. The new drivers are things like a firm's ability to raise more money to get bigger, what's called the capital increase game. And this is where smaller firms have a huge advantage. Other big drivers are growing their margin lending business. And, once again, the quality of their investment portfolio becomes super important.
I mean, it's just simple math, right? A smaller company can double its capital base way, way more easily than a giant company can. It's just easier to go from 5 trillion to 10 trillion than it is from 50 trillion to 100 trillion. That agility is the secret weapon that lets these smaller firms just post explosive growth in a bull market. It's why they so often leave the giants in the dust.
All right, let's wrap all this up. We're going to boil it down into a simple but really powerful framework that you can use to analyze these stocks like a pro.
Here it is, just 4 simple steps. First, figure out where we are in the market cycle. Are we near a bottom, or are we in a recovery? If you think we're at a bottom, you go hunting for the companies that are swimming in cash. But if we're in a recovery, you pivot. You start looking for those nimble, small caps that have clear plans to raise more money and grow. And step 4, always, always, take a hard look at the quality of their investment portfolio.
And that really brings us to the final, most important question. Using this framework, take a look at the market right now. Based on this cycle-aware approach, which companies do you think are set up to win in the next phase? The clues are out there. They're just waiting for you, hidden away on their balance sheets. Thanks for watching.